Thank you very much indeed for the introduction and for the invitation, and to all of you for coming. Now, given the 25-year theme of the evening, I thought I'd talk about an institution which is roughly that age, namely the Monetary Policy Committee. And exactly 25 years ago, I was at the bank, as Michael had said, and a member of that committee. So these are going to be some reflections on what it felt like back then, or rather my 25 years later memories, maybe improved somewhat, of how it actually looked back then. Then I want to talk about the intervening period, and in particular the upsurge in inflation which we've had in the last several years, and some of the fiscal consequences of that. Let me just get my zapper. So 25 years, but I want to begin with a much longer view. This is a table from a paper by Ricardo Rice, who's a terrific economist at the LSE, so deserves respect. And what it shows, going back 800 years, are the economic historian's best efforts to show how the inflation performance was. So left-right is the average level of inflation in each 20-year period. So we've got, we get out of the way, we've got 40 blobs, each one representing 20 years. And on the vertical axis is how choppy inflation was from year to year within those 20-year periods. And the 3 points I want to bring out from this are, first, you see that for most of history, when we were on metallic currency, a lot of it the gold standard, so we were left of the dotted line. The dotted line is 2% inflation. So there wasn't big trend inflation, but it was very choppy year to year. That's point one. Over on the right-hand side, these are the sort of high inflation periods. The four blobs rightmost, the top right is Henry VIII, and then on the sort of far right, lower down, well, he had his fiscal problems and other problems, and monetary consequences flowed from that. And then on the right, as you see, is essentially the 20th century after we'd come off the gold standard, and we had this tremendous struggle in this country, as others did, to find a nominal anchor, an anchor for the price level. And a number of you here, we all remember what it was like in the 70s and 80s. So this is zooming in on the last more than 25 years, sort of 35 years. And you see on the left there, this is UK inflation, the remnants of the late 80s inflation. Of course, it had been much worse in the 70s. And on the very right, this sort of ends in 22, a couple of years ago. You get the surge in inflation relatively recently. In between, it was astonishingly calm. And if I just hop back, the other blob I want to point out, the southernmost, that's, in a sense, the first 20 years of independent monetary policy. Incredibly low inflation and incredibly low volatility inflation in that 20-year period. And you see it here, that the solid blue line isn't the inflation target, it's the average over the period. That's at 3%, whereas the target was a little bit lower. See how incredibly, by historical standards, incredibly low and stable inflation was in this period. Now, maybe it's all a big coincidence, or maybe it's partly down to the institutional design and policy decisions that the committee made. There are some zigzags around the financial crisis in the early teens, but if you eyeball those, you'll see that if you were, like, take the 2-year inflation rate, you didn't have, you had 1 year like +4 or 5, but then you had a minus, so it kind of averaged through quite nicely. And an astonishing fact, because under the regime set up in 97, 98, governor has to write to the chancellor if target is missed in any month by more than 1%. That didn't happen for 10 years. So there are 120 months roughly, and it was within that incredibly narrow band, which is, you could only do that with an immense amount of luck. So what I want to do against that context, a few reflections on back then. Then I want to talk about the period, I'm dating it 2000 to 2013. This evening you can think of that as the Kate Barker period, because Kate was on the committee for the bulk of that period. However, beginning about 12 years ago, there were some developments in what the committee was doing, which I, as a kind of old boy looking at it from afar, began to find puzzling. I'm not in a position to say things were done wrongly, but I want to explain why I thought some things were a bit puzzling, and then some comments on the recent period and its consequences. Right, so that's what it looked like. That's the Committee of Nine, plus shadowy figure on the left, Gus O'Donnell. Right, Gus was the Treasury Observer. I want to make 3 points about this group. First of all, and I think Susha would say exactly the same, we had amazing colleagues. Eddie George was a governor. Among his many accomplishments, one which is not often celebrated, but I think should be tonight, he opened the economics department, that building that was on your slide. Eddie George opened that. But particularly if you were an economist, you have 3 great economists there. Mervyn King, and then behind his 2 shoulders, you've got Willem Buiter and Charles Goodhart. And to be especially if you're an economist, to be on a committee with colleagues like that, the whole thing is amazing. We were very argumentative. They're extremely lively debates. Deanne gave no quarter. They were extremely vigorous debates. I think I've never been around a committee table with a less risk of groupthink. I mean, there's always some risk, but this was pretty hammer and tongs, which isn't always enjoyable at the time, but I think it is a good policy recipe. The other thing is we were prepared to be pretty hawkish. So my first meeting, it's done 2. My first meeting was June of '98, which was the first under the new Bank of England Act. Inflation was ticking along at 2.5%, which was on target. It was a slightly different measure of inflation, so it's roughly comparable to 2% today on the CPI measure. We were already at 7.25%. What did we do? We upped the rate to 7.5%. So we had a 5% gap between bank rate and inflation, which was extremely unpopular. But if you have independence, the willingness to do unpopular things is much greater than if politicians are taking the decisions. It was a clear majority vote. I think Deanne was in the minority of 1. And why did we do it? I think essentially 2 reasons. One was this was very early days. We were not confident that inflation expectations were anchored. We thought it was extremely important that we show our anti-inflation resolve, because the prize of anchoring inflation expectations is a very great one. Second point was that sterling had appreciated quite a lot in the previous couple of years, and that was bearing down on headline inflation. But our analysis showed that underlying domestic inflation was much more like 4, possibly even 5%, rather than the 2.5% in the headline numbers. So we wanted to head off that risk, and that's why we did it. I'm pretty sure this is counterfactual history. There were events in the subsequent months. We'd have gone up in July if we had not in June. Another decision I do want to mention, because this was a particularly memorable meeting, and I think it says quite a bit about the committee. So we eased in the autumn of '98. Was the Russia crisis and other things. And the question was, a year on from that, do we start tightening or do we stay where we are? So in September '99, we tightened back up, went from 5 to 5.25. And this was a 7-2 vote. And I did not know, going into the committee room, what the outcome would be. I was pretty confident. I knew I was for up. I knew Mervyn was for up. I knew Sushil and Deanne were not. I really did not know where everybody else was. And there were not corridor conversations in the bank. Eddie George never asked me pre-meeting, what are you going to do? They were real discussions. And it was an enormous surprise to me, and I think others, when we voted to go up. It's a sign of how amateurish we were that we had prepared no statement for that eventuality. And the markets were not, we knew it was not what the markets were expecting. So Gus, who was always he never said anything in the policy debate, but he was very good on communication side. He said, look, you've got to write something. So we had about an hour before the decision went out, and drafting by committee, particularly not a unanimous committee, that's quite a difficult thing to do. And we finally got it done, we thought, with about 10 minutes to go before the noon announcement. And someone was literally going to have to run through the bank and have it typed into some other machine. When Ian Plenderleith, he's the very distinguished person next to Deanne. He was head of markets. He said, "I'm sorry, Mr. Governor, but we cannot possibly say this." And the governor said, "Well, Ian, what is it?" He said, "There's a hanging participle in the second sentence." So Ian was Christchurch classics. So we quickly did the grammar, and away we went. Now, some people would say, well, the crash of 2008, doesn't that show that inflation targeting was flawed? This was a massive policy failure. My view on that is I think that's exactly wrong. The crash was a sign of an enormous policy failure of financial regulation. I believe that the monetary policy regimes in this country and other major countries weathered that really pretty well. You had a very agile response, so base rate came down extremely quickly. There's a chart with different jurisdictions. So by the very, very early 2009, everyone was down near the floor. And the first rounds of quantitative easing, QE, came in. And I think they were perfectly sensible policy response, and together with the fiscal response accompanying all this, I think that saved us from a worse calamity than we experienced then. And in some ways, if you look at the growth path, the productivity path, I think the scars of those events are still with us. So I think this was a perfectly good test of the monetary policy arrangements, which in my view, it passed pretty well. Roll forward a few years, and I want to explain why I thought these events were, I'm using the word puzzling because I'm just sitting at a desk in Oxford. I don't have the analytical capacity of the data of the Bank of England. I'm in no position to say I thought these decisions were wrong, but I did find them puzzling. So I'm going to go through this list and then talk about the last couple of years and then wrap up, and we can do questions. So 2013, new governor, so now it was Mark Carney replacing Mervyn King, and one of the first things was forward guidance. And in August 2013, the MPC majority, Martin Wheel, dissented. They stated an intention not to raise bank rate at least until the unemployment rate had fallen to a threshold of 7%. Unemployment had gone up sharply because of the crisis of 2008-09. Then you had the Eurozone crisis, and it was still well above where it is today. Now, I found this very surprising for a couple of reasons. One is inflation is about the rate of change of a nominal variable. This is like if you're doing the first-year undergraduate macro lectures, which I did for a period of years, real and nominal, they're different. But here, inflation policy was being linked to real variable, the unemployment rate, and moreover, a single real variable, the unemployment rate. Whereas when I'd been there, it was just axiomatic, and we said it in speech after speech, you can't base decisions on one thing. You've got to look at the overall picture, balance things, weigh things, and all the rest of it. And although none of us, not even Charles, were monetarist, we paid quite a bit of attention to the monetary and credit aggregates, which I think the MPC in the teens paid less and less attention to. So I thought this was a very strange policy. And because if you think of those lectures about Phillips curves, I mean, they move around so much. To base something on the unemployment rate, I thought was a very odd thing to do. So what happened was that unemployment came down, and they did not tighten. Now, the defense that the bank people would say, well, look, we said we're not going to raise it until it goes below 7. That's not a statement that we will raise it if it goes below 7. It's necessary versus sufficient conditions. But I think this was not a brilliant attempt to give guidance as to what policy was going to be. So that's puzzle number one. The second one, Kevin Walsh, governor of the Fed, he did a review of the Bank of England's processes, including communication policy. And a number of very sensible things came out of this review. One was reducing the policy meeting cycle from monthly to roughly 6 weekly, so 8 a year instead of 12 a year, which was an excellent decision. Having been in the monthly regime, it was really exhausting. I mean, you never got a proper break because the next cycle and the data were always coming through. A big thing on the communications front is that we now have Super Thursday, so that the interest rate decision and the minutes, and in the relevant months, the quarterly inflation report, as it used to be called, now monetary policy report, they're all published at the same moment. This would have been unthinkable the time I was on the committee, because our arguments didn't just happen up to the policy decision. We then argued about the minutes, and then we argued very much about the inflation report, particularly the introduction and the conclusion and the tone and all that. So we took days to put this package together. So an interesting thing is what has changed within the bank, and I have no visibility of that. It may be that they have all the same discussions, but just earlier. It may be that the bank executive are now, their relationship with the externals is different from the one that existed when I was there. I do not know. But I do think the argy-bargy of the time I was on it was a very healthy thing. And if elements of that have been weakened, I think that would be regrettable. But looking at it from the outside, I don't know. Next thing I want to comment on is the bank's response to the Brexit referendum result in mid-2016. So I totally agreed with the governor that it was a highly unfortunate decision. I was an out-and-out Remainer, but I was very surprised at the Bank of England's response to it. I thought a good response would be keep calm and carry on, but there were various speeches and things made by the governor. And on the 30th of June, so that was something like less than a week after the referendum, he said what he was in favour of easing policy. Now, I don't know whether the committee had authorised that statement. I have no idea. If not, then I don't think he should have been saying that. And certainly if Eddie George had gone out saying something without committee approval, there'd have been outcry, starting with Willem, but not only Willem, I predict. The other thing that puzzled me at the time was, it wasn't clear to me whether the referendum result was uppish or downish or neutral for inflation, because the one immediate thing was that sterling had dropped 10%, and in the short term, that's going to be uppish, not downish for inflation. So I wasn't really clear why a big monetary policy response was called for at all. The way policy loosened was to do an enormous wodge more of quantitative easing. I mean, a huge amount more. Moreover, they extended it to corporate bonds of sort of approved companies. Now, my personal view is a central bank shouldn't do that unless it's absolutely necessary. And an irony is that a couple of years later, they realized that not all the corporate bonds they acquired were as green as perhaps ideal. So then they had to have a great big program and give speeches and write reports on how they were greening the portfolio of bonds which, in my humble opinion, they shouldn't have acquired in the first place. Even if they'd been doing the QE, I think they should have stuck to gilts. And I couldn't see at the time the rationale for the QE. Roll forward a few years, I'll say more about QE in a minute. The shock of the pandemic, that I think did require a monetary policy response. I thought that made sense. But the scale of it, the enormous magnitude of more QE, was a bit eye-popping. The pandemic shock, I think, was going to be very negative for demand, as was the financial crisis, 2008. But it was clearly also an enormous hit to the supply side. So if you think that prices go up when demand exceeds supply at prevailing prices, which I hope that's what you were taught, I think that's basically correct. It really wasn't clear even which way this would go, because the supply side was taking such a hit at the same time. And I gave a talk to my college community, so mixed subject backgrounds. I didn't put it in yellow at the time, but I'm doing it tonight. A big difference, I think, between 2020 and 2008 in economic terms was that one was essentially a demand shock, and the other was a both shock with a huge effect on the supply side. So again, I thought the scale of the response was puzzling. So here you see the different phases of QE The first two lots, this was immediate aftermath of the crisis, and then the Eurozone crisis, when that took hold in kind of 2010, 11, 12, culminating in the Mario Draghi do what it takes speech on the eve of the London Olympics. That totaled 375 billion. Brexit increased that by 20%. It was another 75. And then they doubled it again to 895. In relation to GDP, that's something like 40% of GDP. One is a stock and one is a flow. But that is an idea of the magnitude. And I thought that was just enormous. Now, was it a good idea? My view is that the 2009 to 2012 made a lot of sense. It started off with long-term interest rates. The yield curve would be out at something like 4%. To stimulate economic activity, you want to try and bring that down. So both by the gilt purchase and by the signaling effect of bank rates going to be lower for longer, I thought those phases of QE made sense. However, when you got into the mid-teens, and even when the pandemic hit, it's not so clear that more and more QE does much for you. I think you really do get into diminishing returns. Not zero, but I think they get weaker and weaker. And there's an economist who calls himself the grumpy economist, John Cochrane, who has a blog. And he's a great sort of macro money finance economist. He likens it to M&Ms. He said when interest rates, even long-term, are already super low, if you've got them down from 4 to 1 or 2, then issuing bank reserves to buy up long-term bonds that are already yielding not very much, this is shuffling around very similar bits of paper or electronic bits of paper. And he says it's like the dietitian saying, got to lose some weight, I'm going to take away your red M&Ms and give you green M&Ms instead. It's not going to do anything for you. There's a stratospherically intellectual joke lurking behind this, which M&Ms, they're American Smarties. It's also an allusion to the Modigliani-Miller theorem, which some of you might remember. And Cochrane also went on to write a piece on the Michelson-Morley experiment. He's really into the M&M stuff. That was this great experiment in physics where they went up to work out what the speed of light was when you pointed the thing one way rather than another, and they discovered it didn't make any difference to anything. So his view, in short, is that quantitative easing like this isn't going to do very much at all for the economy. But what it's going to do a huge amount for, if you do it on scale, is it shortens the maturity of government debt in private hands. So you are increasing fiscal risk for the state because the maturity of government debt, which on average used to be high in this country in double figures years, came down a lot because of this. So the government is going to have to go back to market sooner than it would have done in the absence of this. And that can be potentially a large effect. So I think the heightened fiscal risk was entirely foreseeable. Whether it would crystallize or not was not foreseeable. Could go either way, but the sort of variance, the risk to the fiscal position, I think was geared up by this. And how's it turned out? Well, for up until 2022, if you were just interested in the profit and losses, which not the right calculation, but if that was your focus, it went amazingly well. The state made essentially a profit of about 120 billion because bank rate, which it was paying out on reserves, was close to zero, like 0.5% or whatever, whereas it had bought in bonds that had been yielding, I don't know, 3s and 4s. However, when you get the inflation surge and yields jump, it goes the other way. So the solid line, we've had this period of positive cash flow, followed by a projected period of really negative cash flow. So this is OBR in October. So that path, the aggregate net cash flow, is coming out on that chart as minus 115 billion, which is a lot. So the second half of it is a minus more than 200 billion swing. Now, as gilt yields move around, they whip around, then that line is going to move potentially quite a lot. 100 basis point move, a 1% move on the yield curve, makes a swing of 50-odd billion on their estimates. Where gilt yields are today are much better than they were a couple of weeks ago. It's lower, but they are higher, I think, by about 1/4 percentage point from where they were when that chart was put in. And there's a quarterly update from the Bank of England's asset purchase facility, which we'll get the new numbers. A calculation I would love to do, but I don't have the means. I'd love to say, okay, let's take what happened in the QE of 2009 to 12. Separately, let's look at what happened to the QE of 2016 to 20 inclusive, and look at the fiscal consequences of each of those. Now, a proper calculation has to say, yeah, but everything's endogenous in the economy, there'll be loop effects and feedback and blah, blah, blah. But I think even the crude calculation of those two phases would be very interesting to see. And my belief is that given where gilt yields are today, or at the time that chart was put together, the 2016 to 20 QE, it leads to a projection of a staggering fiscal cost. Could swing back the other way, could get worse, who knows. But the fiscal consequences, I think, are underappreciated in a lot of discussion around these issues. So what about the inflation surge? So this shows how inflation rate was low and stable until 2021. Then we have this woomph in this country and in others. In our case, to over 10%. And that peak would have been higher, but for the retail energy price support measures, it might have been something like 12 or 13. We're now back into much more comfortable territory, but that is a very big, very prolonged overshoot of the like we had not seen since the late 80s. So this is a big event. And I think people will be debating why it happened. For a long time. I think we had here in the US and elsewhere incredibly expansive fiscal policy and ultra loose monetary policy as those extra waves of QE illustrate. Part of it is energy. Those are the purple ups and downs you see on that chart, but it's not just energy. And the big policy question now is, have they done enough? Can they ease? If so, at what pace? Fed last night is on hold. We'll see what the Bank of England does. ECB, I think, today came down. So this is the big debate. The most recent UK numbers on core inflation were good. On the labour market side, less so. But we will see. Let me end partly by looking over this 25 years at these different periods. So imagine, magically, you'd had 2% inflation from May 97, when Gordon Brown gave the bank operational independence, for the period to May 21. This is before you had the takeoff in inflation in the UK. Over that period, the CPI was up 60%. 2% inflation would have taken it up 60%. It was actually up 58.3%. It's unbelievably similar, these numbers, given the noise in the economy. And indeed, if you adjust for the difference between different inflation measures, arguably even that difference evaporates. But the magnitude of the overshoot that we had in 21 through 24 was really large. And over December 24 versus May 21, the CPI was up 22%, whereas had it been 2% inflation through that period, it would have been 7% over those 3 years or so. So this is basically, the price level is 15% higher than it would have been. So that's a very big overshoot. We can discuss, but I'm conscious of time, maybe in Q&A about how the Bank of England responded to that. Let me just say one thing. I thought the Bank of England had a flashing lights inflation problem evident in the second half of 21. In this building, upstairs, the annual dinner of the Society for Professional Economists took place in late September 21. The governor was the speaker. I was surprised, a bit disappointed about the lack of robustness and energy that the Bank of England was then bringing to the inflation problem. They did a teeny increase in December of that year, and then they went up this staircase of tightenings through 22 and 23. Where is it going to go now? Very, very difficult to know. I'm certainly not, I don't have a prediction. So my view is that policy was much too loose in that period, and fiscal policy too, that they could have tightened much more sharply. And lots of voices were saying this. This is the excellent House of Lords Economic Affairs Committee. This is in mid-21, in a report on what they thought was the excessive use of QE. And they particularly make the point that unless the Bank of England nails this problem, their reputation and their trust in the mandate could be at risk. So I think it is really important that we don't get a resurgence, and I hope that they have done, or if necessary, will do enough to prevent that happening. Let me end with, just to underline the point about the fiscal harm which current yields is in prospect. I'd first say that 25 years ago, our job was much easier than what more recent committees have had. We were nowhere near we were at 7.5%, so nowhere near the lower bound on interest rates. It was in the nice decade. Productivity growth was not great, but decent. It was ka-ching, ka-ching, ka-ching. Every quarter was positive growth. I think partly because we had the UK had finally got a reputation deserved for price stability. Those who had to deal with the financial crisis, and in particular the pandemic, then you have the Russian invasion of Ukraine and all the rest, much, much harder circumstances. Yet, I think there's a very big question mark about the scale of the QE that happened in that period, which I think, my own view then, and I actually feel it more now, I think was went well beyond what was necessary or called for. And that, in some ways, is a fiscal gamble, and at the moment, it's not looking in great shape. Sorry to end on a gloomy note.
Okay, well.